The Financial Freedom Formula, From Goals to Growth. Written by Ronnie Rowland, published by Growth Literacy Lounge. Introduction. The Financial Freedom Formula, From Goals to Growth. You're about to embark on a transformative journey that transcends the conventional boundaries of personal finance. Here, we're not just talking about managing money, we're delving deep into the art and science of financial empowerment. This book is your roadmap, filled with wisdom, strategies, and actionable steps to help you navigate the often tumultuous waters of personal finance with confidence and clarity. Subscribe to the channel for more videos like this. Chapter 1: Setting the Stage for Success. Welcome to the first step on your transformative journey to financial freedom. As you stand at the threshold of change, it's essential to understand that financial empowerment isn't just a destination, it's a process. And like any profound journey, it begins with a single, yet powerful, step: cultivating financial literacy. Financial literacy, your foundation. Think of financial literacy as the bedrock upon which your financial house is built. Without it, the structure may crumble under the slightest pressure. But with a solid foundation, you're prepared to withstand any storm. Financial literacy involves understanding the basic financial concepts: budgeting, investing, debt management, and savings. It's about grasping the value of money, not just as a currency, but as a tool for creating the life you desire. The power of knowledge: every decision, from the minor purchase to the most significant investment, becomes an informed choice. Confidence in decision-making: with knowledge comes confidence. Confidence to ask the right questions, to challenge assumptions, and to make decisions that align with your goals. Setting the stage. Before diving deep into the mechanics of financial planning and management, let's set the stage for success. This involves a shift in mindset, from seeing money as a source of stress to viewing it as a resource for empowerment. It's about moving from a reactive stance, where life's events dictate your financial moves, to a proactive approach, where you control your financial destiny. Mindset shift: begin by visualizing your life not as it is but as it could be. Imagine the freedom of living debt-free, the security of a robust savings account, and the possibilities of financial growth. The role of discipline: discipline is your ally. It's the bridge between setting financial goals and achieving them. Discipline transforms plans into action and dreams into realities. Embracing the journey. As we embark on this journey together, remember that financial empowerment is not a one-size-fits-all formula. It's a personal journey that reflects your unique goals, values, and circumstances. There will be challenges, but each is an opportunity to learn, grow, and move closer to your vision of financial freedom. Be patient. Financial growth is a process. Celebrate your progress, no matter how small. Stay committed. Your commitment to this journey is the key to unlocking your financial potential. Looking ahead. As we wrap up this chapter, think of financial literacy as knowledge to be acquired and the first step in a transformation journey. In the next chapter, Crafting Clear Financial Goals, we'll delve into the heart of financial planning. Setting clear, actionable goals is the compass that will guide you through the complexities of personal finance. It's about turning your dreams into plans and your plans into action. Stay tuned as we embark on this exciting journey together. Together, we'll explore how setting clear financial goals is not just about marking a destination on your financial map, but about charting a course toward a life of abundance and freedom. Chapter 2: Crafting Clear Financial Goals. The art of goal setting, our next stop on this transformative journey towards financial freedom. If financial literacy is our foundation, then clear, well-defined goals are the blueprints for our future. They're not just wishes or hopes, they're specific, measurable objectives that will guide every financial decision you make from here on out. The power of goal setting. Goal setting is a potent tool. It turns the intangible into the tangible and transforms dreams into actionable plans. By defining what financial success looks like for you, you're not just hoping for a better future but planning for it. Specificity is key. The more specific your goals, the more accurate they become. Instead of saying, "I want to save money," try, "I want to save $10,000 for a down payment on a home in 3 years." Measurability matters. How will you know you've achieved your goal? by making it measurable. In the example above, not only is the amount specific, but the time frame also provides a metric for success. The role of values in goal setting. Your financial goals should reflect your values and what's truly important to you. This alignment ensures that your journey toward financial freedom is not just about accumulating wealth but about creating a life rich in meaning and purpose. Value-driven goals. Consider what matters most to you. Is it security for your family, freedom to travel, or the ability to give back to your community? Your goals should be a reflection of these values. The why behind the what. Understanding why a goal is essential to you adds a layer of motivation crucial when the going gets tough. Setting your goals. Let's break down the goal-setting process into actionable steps. Reflect on your values. Take some time to think about what's truly important to you and the kind of life you want to lead. Define your financial goals. Using your values as a guide, define your financial goals. Remember to be specific and measurable. Categorize your goals. Break your goals down into short-term, within a year, medium-term, 1 to 5 years, and long-term, 5 years or more, categories. This will help you prioritize and focus your efforts. Write them down. There's power in putting pen to paper. Writing down your goals makes them real and tangible. The journey ahead. As we close this chapter, remember that setting goals is just the beginning. The real magic happens in the pursuit of these goals. In the next chapter, Mastering Mindful Budgeting, we'll explore how a well-crafted budget is a financial tool and a roadmap to help you navigate your financial goals. We'll delve into how mindful budgeting can align you with your values while ensuring you make the most of every dollar. So, as we look forward to the next chapter, reflect on your goals and the underlying values. Think of each goal as a stepping stone toward the life you desire. With each step, you're not just moving closer to financial success but crafting a life of purpose and fulfillment. Chapter 3: Mastering Mindful Budgeting. Welcome to the cornerstone of financial empowerment, mindful budgeting. As we've laid the foundation of financial literacy and sketched out the blueprints of clear financial goals, it's time to discuss the tool to help you build your financial future brick by brick. Mindful budgeting is not just about tracking expenses and income. It's about making conscious decisions that align your spending with your values and goals. The essence of mindful budgeting. Mindful budgeting allocates your financial resources with intention and awareness. It's about understanding where your money goes and making choices that reflect what's truly important to you. Conscious spending. Every dollar you spend is a reflection of your priorities. You choose the life you want to live by choosing where your money goes. Flexibility. A mindful budget is not set in stone. It's flexible, adapting to changes in your life and priorities. Creating your mindful budget. Building a budget that reflects your goals and values might seem daunting initially, but it's more straightforward than it sounds. Here's how to get started. Track your income and expenses. For 1 month, keep track of every dollar that comes in and goes out. This will give you a clear picture of your current financial situation. Categorize your expenses. Group your expenses into categories. Example: housing, transportation, food, and entertainment. This will help you see where your money is going. Align your spending with your values. Look at your expenses. Do they reflect your values and goals? If not, it's time to adjust. Set spending limits. Based on your income, goals, and necessary expenses, set limits for each spending category. The role of savings in mindful budgeting. Savings play a critical role. It's not just about what you're spending, it's also about what you're saving for future goals, emergencies, and investments. Pay yourself first. Make savings a non-negotiable part of your budget. You are setting aside a portion for savings before you allocate money to any other expense. Emergency fund. Aim to save enough to cover 3 to 6 months of living expenses. This fund will be your financial safety net. Budgeting as a lifestyle. Mindful budgeting is more than a financial strategy. It's a lifestyle choice. It's about living with intention, making choices that bring you closer to your goals, and finding joy in the journey. Regular reviews. Your budget should evolve as your life does. Regularly review and adjust your budget to reflect changes in your income, expenses, goals, and values. Embrace the journey. Enjoy aligning your financial choices with your dreams. Celebrate the small victories along the way. Looking ahead as we wrap up this chapter on mindful budgeting, remember that this tool is your ally in navigating the path to financial freedom. In the next chapter, Eliminating Debt Strategically, we'll explore how to tackle one of the most significant barriers to financial empowerment: debt. We'll dive into strategies for paying down debt without sacrificing your quality of life and how becoming debt-free is a financial achievement and a milestone on your journey to financial freedom. Stay tuned as we continue to build on the foundation we've laid. With each step, you'll be not just managing your money but crafting a life rich in purpose and fulfillment. Chapter 4: Eliminating Debt Strategically. As we journey deeper into financial empowerment, we encounter a formidable obstacle many face: debt. It's a word that carries weight, often bringing with it feelings of constraint and anxiety. But fear not, our next chapter is about turning what may seem like an insurmountable hurdle into a manageable part of your financial landscape. Eliminating debt strategically is not just about paying off what you owe, it's about reclaiming your financial freedom and making room for growth. Understanding debt: before we can conquer debt, we must understand it. Debt is not inherently bad, it's a tool. Whether it becomes a weight around your neck or a stepping stone to your goals depends on how you manage it. Good debt versus bad debt. Good debt can be an investment in your future, such as a mortgage for a home that appreciates, or a student loan for education that leads to higher earning potential. Bad debt, on the other hand, typically includes high-interest credit card debt or loans for depreciating assets. The cost of debt: interest payments can eat into your budget, diverting funds that could otherwise be used to reach your financial goals. The longer you carry high-interest debt, the more you pay in the long run. Strategies for eliminating debt. Now, let's dive into strategies for tackling debt head-on, transforming it from a burden into a challenge that, once overcome, leaves you stronger financially. The Snowball Method: start by paying off your smallest debts first while making minimum payments on more significant debts. Each time you pay off a debt, move on to the next smallest one. This method can provide quick wins and build momentum. The Avalanche Method: alternatively, focus on paying off debts with the highest interest rates first while making minimum payments on the others. This approach can save you money and interest over time. Consolidation and refinancing: for those with multiple sources of debt or high interest rates, consolidating debts into a single loan with a lower interest rate can simplify payments and reduce costs. The psychological impact of debt freedom: eliminating debt is not just a financial achievement, it's a monumental step towards psychological freedom. Debt often carries emotional weight, affecting our stress levels, self-esteem, and happiness. Reducing stress: paying off debt can significantly reduce financial stress, providing relief and accomplishment. Increased financial security: being debt-free increases your financial security, giving you more flexibility to handle unexpected expenses and invest in your future. The role of an emergency fund: an emergency fund is your best ally in your journey to debt freedom. It prevents you from debt by providing a financial buffer for unexpected expenses. Start small. Even a small emergency fund can provide security as you work towards paying off debt. Build gradually. Aim to build your fund to cover 3 to 6 months of living expenses over time. Looking ahead as we close this chapter on eliminating debt strategically, remember that each step you take towards paying off debt is a step towards financial freedom. In the next chapter, Building Your Emergency Fund, we'll explore how to create and grow this crucial financial safety net. We'll discuss saving strategies, prioritizing your emergency fund alongside other financial goals, and how this fund is the cornerstone of economic resilience. As we move forward, remember that overcoming debt is not just about numbers, it's about setting yourself free to pursue your dreams and goals without restraint. Let's continue this journey together, building a future where your finances are a source of strength and empowerment. Chapter 5: Building Your Emergency Fund. Congratulations on navigating through the terrain of debt elimination. As we move forward on our journey to financial freedom, our next milestone is constructing a robust emergency fund. This financial safety net is essential for the peace of mind it brings and its role in safeguarding your financial future against unexpected events. Let's delve into the hows and whys of building and maintaining this critical component of your financial health. Why an emergency fund is essential. Life is full of surprises. Not all are pleasant. A sudden job loss, unexpected medical bills, or urgent home repairs can destabilize even the most well-planned budget. An emergency fund acts as a financial buffer, ensuring that such unforeseen events don't derail your financial goals or plunge you back into debt. Prevents falling into debt. With a financial cushion, you're less likely to rely on credit cards or loans in times of crisis. Provides peace of mind. Knowing you have emergency funds can significantly reduce stress, allowing you to focus on solving the problem. How much should you save? The size of your emergency fund will vary based on your circumstances, including your income stability, monthly expenses, and whether you have dependents. A general rule of thumb is to save enough to cover 3 to 6 months' living expenses. However, starting with a smaller amount, like $1,000, can provide security as you build up your fund. Building your emergency fund, step by step. Start small. Begin by setting a modest initial goal, such as saving $1,000. Achieving this first milestone can motivate you to continue saving. Make it automatic. Set up automatic transfers to your emergency fund from your checking account. Even small, regular contributions can add up over time. Cut expenses. Look for areas where you can reduce spending and redirect those savings to your emergency fund. Increase your income. Consider taking on a side job or selling items you no longer need to boost your emergency savings. Where to keep your emergency fund. Your emergency fund should be easily accessible but not so accessible that you're tempted to dip into it for non-emergencies. A high-yield savings account is a good option, offering better interest rates than a standard savings account without sacrificing liquidity. Accessibility. Ensure you can quickly access the funds when needed without significant penalties or delays. Separation from other funds. Keep your emergency fund separate from your regular checking or savings accounts to avoid using it for everyday expenses. Regular reviews and adjustments. Life changes, and so should your emergency fund. Regularly review your fund in light of changes to your income, expenses, or family situation. If you've had to use some funds, focus on replenishing it as soon as possible. Annual reviews. At least once a year, reassess your emergency fund to ensure it meets your needs based on your current lifestyle and expenses. Looking ahead with your emergency fund in place, you're better equipped to face life's unexpected turns without jeopardizing your financial stability. In the next chapter, diversifying your investment portfolio, we'll explore how to grow your wealth over time. Investing isn't just for the wealthy, it's a strategic tool for anyone looking to build long-term financial security. We'll break down the basics of investment diversification, why it's essential, and how to get started, even with a modest amount of money. Remember that building and maintaining your emergency fund is dynamic as we read this chapter. It's about preparing for the unknown and ensuring that when life inevitably throws a curveball, you're ready to catch it without losing your financial footing. Let's build a solid foundation for your financial freedom, one step at a time. Chapter 6. Diversifying your investment portfolio. With a sturdy emergency fund safeguarding you from life's unforeseen events, we venture into growing your wealth through investments. Diversification is the watchword in this chapter of our journey towards financial freedom. It's about spreading your investments across different assets to minimize risk and maximize potential returns. Let's explore how diversifying your investment portfolio can be a powerful strategy for achieving long-term financial security and growth. The essence of diversification. In investing, putting all your eggs in one basket isn't just risky, it's a gamble with your future financial stability. Diversification is spreading your investments across various asset classes, such as stocks, bonds, real estate, and cash, to reduce risk. The goal is to achieve a balance where one investment's performance can offset another's underperformance. Risk reduction. By diversifying, you're less likely to experience significant losses when one market sector or asset performs poorly. Potential for better returns. A well-diversified portfolio can help you capture gains from different sectors of the economy, potentially leading to better overall returns. Building a diversified portfolio. Creating a diversified investment portfolio might seem daunting, especially for those new to investing. However, it's more accessible than expected, and you don't need much money to start. Start with your goals and risk tolerance. Consider your financial goals, investment timeline, and how much risk you're comfortable taking. These factors will guide your investment choices. Choose a mix of asset classes. Incorporate a variety of asset classes into your portfolio. A mix of stocks, bonds, and possibly real estate, through real estate investment trusts or REITs, can provide a solid foundation for most investors. Consider index funds and ETFs. Exchange-traded funds, ETFs, and index funds offer an easy and cost-effective way to diversify. These funds track a broad market index, providing exposure to various companies or bonds. Rebalance regularly. Over time, the performance of different investments will cause your portfolio to drift from its original asset allocation. Regular rebalancing ensures that your portfolio aligns with your goals and risk tolerance. The role of time in investing. Diversification isn't just about spreading your investments across different assets, it's also about time. Investing for the long term allows you to ride out the volatility of the markets, reducing the impact of short-term fluctuations on your portfolio. Patience pays off. Time in the market is more important than timing the market. Consistent, long-term investing is a key to building wealth. Compounding returns. The longer your money is invested, the more time it has to grow through compounding returns, where the returns on your investments generate their returns. Looking ahead as we close this chapter on diversifying your investment portfolio, remember that investing is critical to building and sustaining wealth. In the next chapter, Planning for a Comfortable Retirement, we'll explore how to leverage your investments for one of your most important financial goals, retirement. Whether you're just starting your career or are closer to retirement age, it's never too early or too late to start planning for your future. As we continue this journey together, think of diversification as a strategy for your investments and a principle for your financial life. By spreading your resources and risks, you're building a more resilient and flexible financial future that can withstand the ups and downs of the market and the uncertainties of life. Let's move forward equipped with the knowledge and strategies to grow wealth and secure financial freedom. Chapter 7: Planning for a Comfortable Retirement. Embarking on the journey to retirement planning is a pivotal chapter in our quest for financial freedom. It's about envisioning a future where you can enjoy the fruits of your labor without financial worry. Whether you're in the early stages of your career or eyeing the horizon of retirement, it's crucial to strategize and save for those golden years. Let's delve into the essentials of retirement planning, understanding its importance, and laying the groundwork for a future that's not just comfortable but truly rewarding. Understanding retirement planning. Retirement planning prepares for life after paid work ends, financially and in all aspects of life. It involves analyzing your financial situation, projecting future expenses, and saving and investing to secure a comfortable lifestyle in retirement. Start early. The power of compounding interest means that starting early can significantly impact the size of your retirement savings, even if you start small. Adaptability. Your retirement plan should be flexible and adapt to life changes and economic fluctuations. Determining your retirement needs. Before you can chart a course to your retirement, you must understand your destination. How much will you need to retire comfortably? This depends on various factors, including your desired lifestyle, expected lifespan, and healthcare needs. Estimate your retirement expenses. Consider your current expenses and how they might change in retirement. Remember to account for inflation. Calculate your income sources. Sum up potential income sources in retirement, such as Social Security, pensions, and savings. Set a savings goal. The difference between your expected expenses and your income sources is what you'll need to save. Saving for retirement. With a goal in sight, it's time to start saving. Several vehicles are designed for retirement savings, each with advantages and tax benefits. Employer-sponsored plans. If your employer offers a retirement plan, like a 401k or 403b, take advantage of it, especially if they match contributions. Individual retirement accounts. IRAs. Traditional and Roth IRAs are powerful tools for retirement savings, each offering unique tax benefits. Automate savings. Set up automatic transfers to your retirement accounts to ensure consistent savings. Investing for retirement. Investing plays a crucial role in growing your retirement savings. As discussed in the previous chapter, a diversified portfolio can help you achieve the growth necessary to fund your retirement. Asset allocation. Your investment strategy should change as you approach retirement, gradually shifting from growth-oriented investments to more conservative options to preserve capital. Stay informed. Regularly review and adjust your investment portfolio to align with your retirement goals and risk tolerance. Looking ahead. As we conclude this chapter on planning for a comfortable retirement, remember that it's never too late to start, but the sooner you begin, the better. The next chapter, Unlocking Passive Income Streams, will explore how to supplement your retirement savings and income through passive income. We'll delve into the various forms of passive income, how to create them, and their role in achieving financial independence and securing a comfortable retirement. As you contemplate your journey toward retirement, consider it not just a phase of life to prepare for financially, but an opportunity to redefine what prosperity means to you. Let's continue to build toward a future where you can live your retirement years with dignity, security, and joy. Chapter 8: Unlocking Passive Income Streams. As we pivot from the structured world of retirement savings to the dynamic realm of passive income, we enter a chapter that could redefine your relationship with money. Passive income, earnings derived from a source in which the investor is not actively involved, can be a game changer in your journey toward financial freedom. It's about making your money work for you, even when sleeping. Let's explore how unlocking passive income streams can supplement your retirement savings and provide a cushion for greater security and freedom. The allure of passive income. The primary appeal of passive income is its potential to offer ongoing earnings with minimal effort after the initial setup. This can come from various sources, including investments, real estate, and digital assets. The goal is to create a sustainable income stream that supports your lifestyle and financial objectives. Financial independence. Passive income can reduce dependence on traditional employment, offering another layer of financial security. Flexibility. With a steady flow of passive income, you have more freedom to pursue interests, hobbies, or travel, knowing your financial bases are covered. Strategies for building passive income. Building passive income requires upfront effort, investment, or both. However, the long-term benefits can be substantial. Here are several methods to consider. Invest in dividend-paying stocks. Investing in companies that pay dividends can provide a regular income stream with the potential for capital appreciation. Real estate income. Owning rental properties can generate steady rental income. Real estate investment trusts, REITs, offer a more hands-off approach to real estate investing. Create digital products, ebooks, courses, or software that people find valuable can generate ongoing sales with little additional effort after creation. Peer-to-peer lending. Platforms that allow you to lend money directly to individuals or small businesses can offer returns in the form of interest payments. The role of diversification. Just as diversification is crucial in building an investment portfolio, it's equally essential in developing passive income streams. Relying on a single source of passive income can be risky. By diversifying, you spread the risk and increase the likelihood of creating a stable income flow. Experiment and expand. Start with one passive income stream and gradually add others. This way, you can learn what works best without overextending your resources. Managing expectations. While passive income is attractive, managing expectations is essential. Most passive income streams require significant time, effort, or capital. Patience and persistence are key. Realistic goals. Set achievable goals for your passive income. Understand that building a substantial income stream will take time. Ongoing effort. Some passive income streams may require occasional maintenance or updates. Be prepared to invest a little time or resources to keep them flowing smoothly. Looking ahead as we wrap up this chapter on unlocking passive income streams, envision the possibilities that additional income could create in your life. The next chapter, Protecting Your Wealth, will explore strategies for safeguarding your financial achievements. We'll explore insurance, estate planning, and other mechanisms to preserve your wealth for you and your loved ones. So, let's continue on this path toward financial freedom and a life enriched by the peace of mind and opportunities that passive income can provide. Together, we're building a future where economic security and personal fulfillment go hand in hand. Chapter 9: Protecting Your Wealth. As we journey further into the realm of financial empowerment, we've learned not only how to grow our wealth but also the importance of safeguarding it. This chapter delves into the essential strategies for protecting your financial achievements. From insurance to estate planning, these tools ensure that your hard-earned assets are preserved and passed on according to your wishes. Let's explore the practical steps you can take to protect your wealth and secure your financial legacy. Understanding wealth protection. Wealth protection is about creating a safety net that shields your assets from unforeseen events, such as accidents, illness, or legal disputes. It's also about ensuring that your wealth is distributed according to your wishes after you're gone. This aspect of financial planning is often overlooked, but its importance cannot be overstated. Risk management: identifying potential risks to your financial stability and taking steps to mitigate them. Estate planning: making arrangements for managing and distributing your estate after your death. Insurance: the first line of defense. Insurance plays a crucial role in wealth protection by providing financial compensation for loss, damage, or liability. Here are some key insurance policies to consider. Life insurance supports your dependents financially if you pass away. Health insurance covers medical expenses, protecting you from high healthcare costs. Property and casualty insurance protects your home and possessions from theft, damage, or destruction. Liability insurance shields you from financial loss if you're found legally responsible for causing injury or property damage to others. Estate planning essentials: estate planning is about ensuring your assets are distributed according to your wishes, minimizing taxes, and avoiding probate issues. It's a critical step in securing your financial legacy. Will: a legal document stating how you want your assets distributed after your death. Trust can offer more control over your assets' distribution and help avoid probate. Power of attorney allows someone you trust to make decisions on your behalf if you cannot do so. Healthcare directive: specify your wishes for medical treatment if you become incapacitated. Protecting against identity theft in today's digital age, protecting your personal and financial information is more critical than ever. Identity theft can wreak havoc on your financial life, so take steps to safeguard your information. Secure your information: be cautious about sharing personal information, primarily online. Use strong, unique passwords for your financial accounts. Monitor your accounts: regularly check your bank and credit card statements for unauthorized transactions. Looking ahead. As we conclude this chapter on protecting your wealth, remember that financial empowerment isn't just about accumulating assets. It's also about safeguarding them for the future. In the next chapter, Embracing Continuous Financial Learning, we'll focus on the importance of lifelong learning in finance. We'll explore how staying informed and adaptable can help you navigate the ever-changing financial landscape and continue to grow your wealth effectively. As we prepare to turn the page, let's reaffirm our commitment to building wealth and protecting it with the same diligence and foresight. After all, the accurate measure of financial success is not just in the wealth we accumulate but in the legacy we leave behind. Chapter 10: Embracing Continuous Financial Learning. As we journey through the landscape of financial empowerment, we've discovered strategies for growing, managing, and protecting our wealth. Yet, the world of finance is ever evolving, marked by new technologies, changing regulations, and fluctuating markets. This reality underscores the importance of continuous financial learning. By embracing an ongoing pursuit of knowledge, you ensure that your financial strategies remain relevant, resilient, and responsive to the times. Let's explore the avenues for lifelong financial education and how they can fortify your journey toward financial freedom. The lifelong journey of financial learning. Financial education doesn't end with mastering the basics of budgeting, investing, or estate planning. It's a lifelong journey that involves staying informed about economic trends, new financial products, and emerging investment opportunities. This continuous learning process empowers you to make informed decisions, adapt to changes, and seize growth opportunities. Stay curious, approach financial education with an open mind and a willingness to learn. Even the most seasoned investors can discover new insights and strategies. Diverse sources. Leverage various resources, including books, podcasts, online courses, and financial news, to gain a broad perspective on financial matters. Adapting to new technologies. The financial world is increasingly influenced by technology, from online banking and mobile payment apps to cryptocurrencies and blockchain. Understanding these technologies can enhance your financial operations and open new investment avenues. Fintech literacy. Familiarize yourself with financial technology, fintech innovations. Many fintech tools can help you manage your finances more efficiently. Cryptocurrency and blockchain. While not without risks, cryptocurrencies and blockchain technology present new investment possibilities. Educate yourself on the basics and the risks involved before diving in. Navigating economic changes. Economic conditions, including interest rates, inflation, and market cycles, significantly impact your financial strategies. Staying informed about these conditions can help you adjust your budgeting, saving, and investing strategies accordingly. Economic indicators. Keep an eye on key economic indicators such as inflation, unemployment, and GDP growth. These can provide insights into the economy's overall health and influence your financial decisions. Market trends. Understanding stock market trends and cycles can inform your investment strategy, helping you to recognize opportunities and mitigate risks. Building a financial network. Surrounding yourself with a community of financially savvy individuals can provide support, inspiration, and valuable insights. This network can include mentors, financial advisors, and peers who share your interest in financial empowerment. Join financial communities, participate in online forums, social media groups, or local clubs focused on financial education and investment. Seek professional advice. Even with a solid foundation in financial education, consulting with financial professionals can provide personalized advice tailored to your unique situation. Looking ahead as we close this chapter on embracing continuous financial learning, remember that financial empowerment is not a static achievement, but a dynamic process. In the next chapter, Cultivating a Growth Mindset, we'll delve into the psychological aspects of financial success. We'll explore how adopting a growth mindset can enhance resilience, adaptability, and overall financial well-being. As we continue on this path, let's commit to lifelong learning, not just as a strategy for financial growth, but as a philosophy for life. The more we learn, the more we realize the vast potential for growth, innovation, and transformation in our financial journeys. Chapter 11: Cultivating a Growth Mindset. As we've navigated through various financial strategies and concepts, it's clear that our mindset plays a pivotal role in shaping our financial destiny. This chapter delves into the psychological foundation that underpins all our financial actions, cultivating a growth mindset. This mindset, characterized by the belief that our abilities and intelligence can be developed through dedication and hard work, is crucial for overcoming obstacles, learning from failures, and achieving financial success. The growth mindset in finance. A growth mindset encourages us to view challenges as growth opportunities rather than insurmountable barriers. Personal finance means seeing financial setbacks not as defeats but as learning experiences. This perspective is vital for navigating the ups and downs of financial management and investment. Embrace challenges. Instead of avoiding financial challenges or feeling defeated, embrace them as opportunities to learn and improve. Learn from failure. Every financial mistake provides valuable lessons. Analyze what went wrong and use that knowledge to make better decisions in the future. Overcoming financial fears. Fear can be a significant barrier to financial growth. Whether the fear of investing in the stock market or anxiety about managing debt, a growth mindset helps us confront and overcome these fears. Educate yourself. Knowledge is a powerful tool for overcoming fear. The more you understand a financial topic, the less intimidating it seems. Start small. Take small steps to build your confidence gradually. For example, if investing seems daunting, start by investing a small amount in a low-risk option. Perseverance and financial goals. Financial goals often require long-term commitment and perseverance. A growth mindset fosters the resilience needed to stick with your financial plans, even when progress seems slow. Set realistic expectations. Understand that economic growth takes time. Setting realistic expectations can prevent discouragement and help maintain motivation. Celebrate progress. Recognize and celebrate your financial achievements, no matter how small. This reinforcement can boost your confidence and commitment to your goals. Cultivating a growth mindset. Developing a growth mindset is a deliberate process that involves changing our thoughts and abilities. Here are some strategies to cultivate this mindset. Adopt positive self-talk. Be mindful of your internal dialogue. Replace negative or limiting beliefs with positive affirmations about your ability to grow and succeed financially. Seek feedback. View feedback as a gift that can help you improve. Seek advice and constructive criticism from financially savvy individuals or mentors. Embrace lifelong learning. Commit to continuous learning in all aspects of personal finance, reinforcing the belief that you can expand your financial knowledge and skills over time. Looking ahead. As we conclude this chapter on cultivating a growth mindset, we prepare to focus on managing financial risks and opportunities. In the next chapter, we'll explore strategies for balancing the inherent risks and potential rewards of various financial decisions, emphasizing the role of a growth mindset in navigating these complexities confidently. So, as we continue on this transformative journey, remember that cultivating a growth mindset is about more than just financial success. It's about fostering a life of continuous growth, learning, and self-improvement. With this mindset, every challenge becomes an opportunity, and every failure is a stepping stone to more significant achievements. Let's move forward believing that our financial capabilities are boundless and our growth potential is limitless. Chapter 12: Managing Financial Risks and Opportunities. Embracing a growth mindset equips us with the resilience and adaptability needed to navigate the landscape of complex financial risks and opportunities. This chapter delves into strategies for identifying, assessing, and balancing these risks and opportunities, ensuring we make decisions that align with our financial goals and risk tolerance. Let's explore how to approach financial risks judiciously while seizing opportunities for growth and prosperity. Understanding financial risks. Financial risk involves potential loss in your financial endeavors, whether investments, business ventures, or personal finance decisions. Recognizing and understanding your risks is the first step in managing them effectively. Market risk: the risk of losses due to factors that affect the overall market. Credit risk: the risk that a borrower may default on any debt. Liquidity risk: the risk of being unable to sell an investment fairly and promptly. Inflation risk: the risk that inflation will undermine the performance of your investments. Assessing your risk tolerance. Before managing risk, you need to understand your risk tolerance. This is the variability in investment returns you are willing to withstand in your financial planning. Financial assessment: consider your current financial situation, including your income, debts, savings, and investment goals. Psychological assessment: reflect on your comfort level with uncertainty and your reaction to potential financial losses. Strategies for managing risk. With a clear understanding of your risk tolerance, you can employ strategies to mitigate risk without stifling growth opportunities. Diversification: as previously discussed, spreading your investments across different asset classes can reduce risk. Hedging involves taking an offsetting position in a related security to manage the risk of adverse price movements. Insurance: using insurance products to protect against unforeseen events is a critical risk management strategy. Emergency fund: maintaining an emergency fund provides a financial buffer to help you manage unexpected expenses without derailing your financial plan. While managing risk is crucial, recognizing and seizing financial opportunities is equally important for achieving financial growth and prosperity. Stay informed. Keep abreast of economic trends and financial news to identify potential investment opportunities. Continuous learning: expand your financial knowledge to understand new investment vehicles and strategies. Networking: engage with a community of like-minded individuals to exchange ideas and uncover opportunities you might not have discovered on your own. Balancing risks and opportunities. The key to successful financial management is finding the right balance between risks and opportunities. This balance will vary depending on your financial goals, risk tolerance, and stage of life. Please review and adjust. Regularly review your financial plan and investment portfolio to ensure they align with your risk tolerance and goals. Be prepared to adjust your strategies as your financial situation and the market environment evolve. Looking ahead as we conclude this chapter on managing financial risks and opportunities, we prepare to embark on the next phase of our journey. The power of giving back, where we'll explore the impact of philanthropy on personal wealth and overall well-being. Giving back is not only a way to contribute to society, but also an opportunity to enrich our own lives and financial journeys. We continue forward. Remember that managing financial risks and opportunities involves making informed decisions that align with your goals, values, and risk tolerance. It's a dynamic process that requires vigilance, adaptability, and a commitment to continuous growth and learning. Let's navigate the complexities of the financial world confidently, embracing the challenges and opportunities that come our way. Chapter 13: The Power of Giving Back. After exploring the intricacies of managing financial risks and opportunities, it's time to shift our focus towards a gratifying aspect of financial prosperity: giving back. Philanthropy, or giving to causes and communities in need, enriches the lives of recipients and the givers. This chapter delves into philanthropy's profound impact on personal wealth, well-being, and the broader journey toward financial freedom. Understanding the value of giving back, philanthropy extends beyond mere financial assistance. It reflects our values, beliefs, and commitment to positively impacting the world. Engaging in charitable activities can provide a sense of purpose, fulfillment, and connection to a larger community. Personal fulfillment. Giving can enhance your well-being and satisfaction by contributing to the greater good. Community impact. Your contributions can make a significant difference in the lives of individuals and communities, fostering a positive change that transcends monetary value. Integrating philanthropy into your financial plan. Incorporating giving into your financial planning allows you to support causes you care about while managing your financial health effectively. Budget for giving. Allocate a portion of your budget for charitable donations, treating it as a non-negotiable expense. Strategic giving. Consider the most impactful ways to contribute, whether through financial donations, volunteering your time, or offering expertise. Tax benefits. While the primary motive for giving should always be altruistic, it's worth noting that charitable donations can provide tax benefits, making it a financially savvy practice as well. The ripple effect of giving. Philanthropy creates a ripple effect, inspiring others to contribute and fostering a culture of generosity. This collective effort can lead to substantial societal change, demonstrating the power of community and shared purpose. Inspiring others. Your commitment to giving back can motivate friends, family, and colleagues to take action and support causes that are important to them. Building a legacy. Through philanthropy, you can leave a lasting impact beyond financial wealth, contributing to a legacy of kindness and support for future generations. Finding your philanthropic path. The journey towards incorporating philanthropy into your life is deeply personal and varies from one individual to another. Here are some considerations to help you find your path. Identify causes you're passionate about. Reflect on the issues that resonate with you and research organizations that align with those interests. Assess the impact. Look for opportunities to contribute where your resources can have the most significant impact, considering both local and global initiatives. Volunteer your time. If financial donations are not feasible, consider volunteering your time and skills. The value of personal involvement can be immeasurable. Looking ahead. As we close this chapter on the power of giving back, we're reminded that financial freedom isn't just about personal wealth. It's about leveraging that wealth to create positive change in the world. In the final chapter, Reflecting and Planning Ahead, we'll reflect on our journey thus far and explore strategies for continuing our path toward financial empowerment and beyond. We prepare to move forward. Let's carry with us the understanding that giving back is a cornerstone of true financial success. It enriches our lives, strengthens our communities, and forges a legacy of generosity and impact. Let's embrace philanthropy not just as an economic strategy but as a fundamental expression of our values and aspirations. Chapter 14: Reflecting and Planning Ahead. As we arrive at the final chapter of our journey, it's a moment for reflection and forward thinking. From setting clear financial goals to embracing the power of giving back, each step has been part of a broader quest toward financial empowerment and personal fulfillment. Now, let's consider the path we've traversed and strategize for the road ahead, ensuring that the principles of financial wisdom guide us through future endeavors. Taking stock of your journey, reflecting on your financial journey is crucial for recognizing progress, learning from experiences, and adjusting your course. Consider the milestones you've achieved, the challenges you've overcome, and the knowledge you've gained. Celebrate achievements. Acknowledge your progress toward your financial goals, no matter how small. Learn from setbacks. Analyze any obstacles or setbacks you've encountered, extracting valuable lessons that will inform your future decisions. Setting new goals. With reflection comes the opportunity to set new financial goals. As your circumstances, priorities, and aspirations evolve, so should your objectives. Reevaluate your priorities. Life changes, such as career transitions, family growth, or lifestyle shifts, may necessitate reassessing your financial priorities. Set SMART goals. Ensure your new goals are specific, measurable, achievable, relevant, and time-bound. Create actionable plans. Outline the steps to achieve each goal, breaking down larger objectives into manageable actions. Embracing change and uncertainty. The only constant in life is change. Embracing this reality allows you to adapt more fluidly to unforeseen circumstances, whether economic fluctuations, personal life changes, or global events. Build flexibility into your plans. Allow room for adjustment in your financial planning to accommodate life's unpredictability. Maintain an emergency fund. Prioritize your emergency savings as a buffer against unexpected financial shocks. Continuous learning and growth. As underscored throughout our journey, financial empowerment is an ongoing education and adaptation process. Commit to lifelong learning, staying curious and informed about financial matters. Seek new knowledge. Engage with the latest financial books, podcasts, and resources to keep abreast of evolving trends and strategies. Expand your network. Build relationships with individuals who inspire and challenge you to grow financially and personally. Planning for legacy. Looking ahead also involves considering the legacy you wish to leave. This encompasses financial assets and the values and lessons you want to pass on to future generations. Estate planning. Regularly update your estate plan to reflect your current wishes and circumstances. Share your knowledge. Teach your family, friends, and community members about financial empowerment, passing on the wisdom you've accumulated. Final reflections. As we close this book, remember that the journey to financial empowerment doesn't end here. It's a lifelong path marked by growth, resilience, and the pursuit of fulfillment. Embrace each step with openness and determination, knowing that every challenge is an opportunity for growth and every success a milestone to celebrate. Dear reader, thank you for embarking on this journey with me. Remember that empowerment comes from within as you navigate your financial path. With knowledge, a growth mindset, and a commitment to giving back, you can achieve financial freedom and a rich and rewarding life. Let's move forward with confidence, curiosity, and compassion, ready to face the future with resilience and an open heart. Here's to your continued success and financial well-being. Thank you for listening. Subscribe to the channel for more videos like this.